Kitco Mining's special coverage of PDAC is brought to you by Gold Mining and Uranium Energy Corps.
Junior gold developers are coming into their own as M&A is starting to accelerate. True or false? And to answer that, I'm joined here today at the PDAC by David Efle of the Junior Miner Junky newsletter. Good morning, David.
Good morning, Paul. Always great to see you.
Welcome to Kitco. Now, we're seeing M&A in the gold space start to pick up. I think there's 8 active deals right now, including the Sabina Gold deal, which is yet to close, closing any day now. Your portfolio at the Junior Miner Junky newsletter, you focus on development stage companies. So you must be very encouraged to see this increased level of activity.
Yes, part of me is very encouraged and very excited. I mean, we've expected this for quite a while. We knew it was coming. And it's great to see. But on the other hand, you know, I've painstakingly acquired these companies since the middle of last year for myself and my subscribers. And although it's encouraging to see more M&A, we don't want any of our companies taken over quite yet, because, you know, before I purchase something, I have to see at least 3 times upside from my average cost, or else I won't even get into it. So when you see someone like B2 Gold come along and take over Sabina at such a low price, you know, not very many people made money in that transaction. I mean, the Sabina Gold price, the Sabina share price got down to around $1 after going down about 65% over the past few years, and the stock was taken over for about $1.75. That's not even a double. So although it's encouraging to see more M&A, I don't want to see any of my companies taken over too soon.
Well, let's look into that a little bit more. Historically, if you look at gold M&A, the big gold companies don't have a good record of buying smaller companies when the prices are low. They usually wait till the prices are really high, then blow out their balance sheets doing that. So why is this happening now? Have some companies learnt the lesson?
Absolutely. I mean, when we had that big, huge wave of M&A at the end of the last bull market, you had companies taking over projects that were low-grade, bulk tonnage, large projects. They didn't care about the grade of the ounces; they just wanted ounces. And they also did it with dilution, so a double negative. So that has really hurt the sector, and it's taken away the generalist investor out of this sector for the past decade. So I think a lot of them have learned their lessons. You know, they've got stronger balance sheets, they're paying dividends, they're cashed up, but now they're still very, very nervous about pulling the trigger too soon. Okay,
let's dig into some of the deals. There's quite a range of deals, from big mergers to some smaller transactions. So let's look through some of those. Obviously at the top, Newmont making a bid for Newcrest Mining. Putting these together, it will create a gold producer with a market cap of at least 50 billion, head and shoulders above anybody else. What do you think of that one?
Yes, that'll put them in a league of their own. I mean, not too long ago, 5 years ago, Barrick used to be the top dog, and we came to PDAC here in 2018, and they announced the Randgold merger, and they got even bigger, and we thought, okay, there goes Barrick getting even bigger. But lo and behold, we had Newmont come along about a month later and announce they were taking over Goldcorp, and they became the top dog. And they've been the top dog ever since. And now if this deal goes through, you know, if they end up making their 4th bid for Newcrest, which I think is going to take place, it's just a matter of when, not if. If that deal eventually happens, they'll be producing twice as much as Barrick, so they'll be in a league of their own as far as gold producing is concerned.
Is that positive for the gold sector, having a company that much bigger than the next one?
I think it is, because not only would they be the biggest, but they're paying a close to 5% dividend at this price, and they've said they're going to maintain that 5% dividend as long as the gold price remains above $1,800 an ounce.
Okay, you mentioned that B2 Gold buying Sabina Gold and Silver. Let's dig into that one a little bit. B2 is getting a strong North American presence with that transaction. And going back to its roots, the team at B2 Gold, formerly Beamer, built mines in the Arctic before. Sabina has permitting. It's almost completed the earthworks of the build, which many people say is the most risky part of a development. So B2 is basically buying a fully de-risked asset. Is that going to be the trend going forward?
Yes, I think so. I mean, you know, a lot of these companies too, they've taken 19.9% ownership in a lot of these stocks also, and all these juniors also, But I thought the B2 Gold acquisition of Sabina was interesting and kind of out of left field, because we all thought that Agnico would end up taking over Sabina, because basically they're the only miner that's proved they can mine successfully in Nunavut. And when China was basically taken off the table as far as a possible acquirer of any assets in Nunavut, that left basically Agnico, we thought, as the only suitor. But Clive was very shrewd in his bid to take over Sabina, and his timing was perfect, because Agnico is final, just got the board approval to take over Yamana's assets, so they're tied up with that. So I'm sure he figured, hey, they're not going to be able to make a competitive bid because they're tied up with the Yamana acquisition.
And they also bought the Hope Bay asset from TMAC Resources a year or so ago, so maybe they've got their hands full in the Arctic anyway.
Exactly.
Okay, let's stick with Sabina for the moment, because Kinross Gold bought Great Bear Resources last year. It rapidly divested its assets in Russia after Russia's invasion of Ukraine, and some people think it was a bit of a knee-jerk reaction to refill its pipeline with something, and it bought Great Bear Resources. But Great Bear Resources, best case scenario, looking at 8 to 10 years to production. So if it had a production gap to fill, why didn't it come in for Sabina? And again, it's used to operating, it's familiar with operating in Arctic environments. So at some level, that would be a good fit.
That's a great question. Yeah, also with Fort Knox over in Alaska. Absolutely, that is a great question. But Kinross, when they came out with the resource, finally, that was the interesting thing about Great Bear. They de-risked that project without ever even issuing a resource announcement. So when the resource announcement was finally made by Kinross, it was a lot less than the market expected, and it turned out to be, for now, about $250, $260 an ounce, which is very high in this environment. So, and I'm pretty sure that, as I recall, that Barrick was interested also in that Dixie project of Great Bears.
Well, maybe Barrick's day will come when Kinross' share price dwindles further. Okay, let's look at the another level of the type of transactions we're seeing at the moment. And I want to mention Integra Resources merging with Millennium Precious Metals. No production involved. Integra's got a development stage project in Idaho, De La Mar. Millennial brings them a sort of an exploration pipeline. This is the kind of transaction a lot of people in the gold sector, such as Van Eck, a big gold investor, has been calling for a long time. Consolidation of the explorers. Makes a lot of sense. The market didn't receive it very well.
No, they didn't. And I know before this deal took place, there was another deal in the works, I think, with a few other companies in that area that fell through. So we knew that something was going to take place in that area. But as you're saying, yes, the market really didn't like it. They also announced a $35 million raise at the same time, and both share prices, which were already trading at all-time lows, went even further lower.
Doesn't bode well for the possibility of more transactions of that kind if that's the response from the market.
Maybe not, right? But I still think we're going to see more M&A, creative M&A going forward.
Okay, let's talk a little bit more about the market. S&P's released their annual global exploration trends report, and within that it says 50% of exploration spend or exploration budget worldwide is for gold. But it seems we're in a very difficult financing window for gold junior explorers. Why is that, and will this change this year?
Yeah, it's interesting. We saw the capital markets window open again here when the gold price was zooming towards 2,000 here, coming, before we got into February, and then as soon as the gold price reversed, the capital market window kind of closed again. I mean, there's been a lot less financings. So, but I think yes. I mean, we all need two things in this sector. I think the number one thing we all need is for more generalist capital to come in. And that's why these mergers and acquisitions, especially the mergers of the majors, are taking place. They need to get bigger to attract these investors. They're paying good dividends. They just need to get bigger. And also, we also need a $2,000 floor in the gold price as opposed to a 12, 13 year ceiling. So once the market believes that we've got a $2,000 floor in the gold price as opposed to a 12 or 13 years ceiling, then I think we're going to see a lot of things improve in this sector.
Well, one thing that became very clear in January and February this year when the major gold producers were releasing their resource and reserve statements, their annual resource and reserve statements, pretty much all of them have increased their gold reference price. Barrick went from $1,200 per ounce to $1,300 per ounce. A lot of companies are using $1,400 per ounce. Does that support the thesis for higher gold prices?
Oh, absolutely, it does, yes. I mean, this is the reason why the mining sector has done so poorly over the past few years, even though the gold price has done very well to hold up in this higher interest rate environment and a higher dollar environment. The price of everything to get for gold producers, explorers has gone up exponentially. The price to drill it, the price to explore for it, the price to build the mine, the price to get it out of the ground has all gone up while the gold price has gone nowhere. And this typically happens in this sector. You know, when you have major lows, you see things like ounces in the ground in top tier jurisdictions going for less than $10 an ounce, like right now. And then the other end of when the pendulum swings the other way, when we have major tops and we have excess in this sector, you see things like we saw in 2010, 2011, where Kinross paid $1,000 an ounce in the ground in a tier 2 jurisdiction, and Newmont paid $1,200 an ounce in the ground for Frontier in a tier 1 jurisdiction.
Okay, David, you study sort of the mechanics behind the gold price quite a bit, and people can read about that in your weekly newsletter. What's the outlook for gold? We're currently around $1,850 per ounce. What's it going to take to get to 2,000 and beyond?
Well, there's a few things. You know, we don't want it to be a geopolitical event because that's very possible. And but the gold price generally, you know, it runs up to these major resistance areas. It consolidates for a while, and then when it finally breaks through, it has a huge run. It happened at $500 gold. You know, it took 10, 15 years for the gold price to finally get above $500. When it did, it went up very quickly, and it pretty much doubled to $1,000 an ounce within the next few years. And then once it got to $1,000 an ounce, it tested $1,000. It got to 1,000, tested it 3 times, and then that 4th time, once it broke out, it ran it to $2,000 an ounce in a few years. So we've had 3 tests now of $2,000. I think this 4th test is going to be successful based on geopolitical, based on macroeconomic, based on what's happening with loss of faith in government, loss of faith in central banks and their monetary policies. I think that's going to be the main driver to get the price over $2,000 an ounce. Okay,
thank you, David. Now, I want to talk a little bit finally to close with the advice you give your subscribers, because the setup for gold is good. As you just mentioned, it's not quite there yet. The junior developers seem to be becoming attractive to the majors, although their share prices are perhaps too low to really get really excited. So are we in the most difficult phase for investors? Because it's really much sit and hold, isn't it? And sitting and not doing anything is very few people with that discipline.
It is, but it's sitting and holding the right companies, because, you know, 85 to 90% of the junior sector is, you know, pretty much garbage. As we've heard from our friend Rick Rule, and he's absolutely correct, a lot of these companies need to go away. You know, in an environment like this, you'd think more would go away, but that's not happening. You know, as soon as a financing window starts to open, you know, a lot of these lifestyle juniors, they get let's keep the lights on money, small raises to keep going.
Well, I'm going to jump in there, David, because despite the fact we're seeing some transactions, we're also seeing the perpetuation, because some management teams can't help but, okay, let's carve out a couple of assets, spin it out into another underfunded junior explorer.
Absolutely, yes. I mean, and a good example is another merger, another acquisition that just took place in ATAC Resources in the Yukon. We had Victoria try to make an opportunistic bid for the company. You know, after it's gone, after the share price has been obliterated. You know, this was once a $1 billion market cap company after they made a major discovery back in the last bull market, and ATAC just spurned it right away. But the following Monday, Hecla comes in and makes an offer for just $5 million more, but they also let them spin out a copper company and added money to that. Okay, that keeps them with jobs. That they have jobs, they have a new company that they can promote, and they could try to sell to investors and de-risk. So that was very attractive to them, so they took the offer.
It's going to be very interesting to see how this year develops for the junior gold explorers and developers. Hopefully we'll have more opportunities to talk about that, David. David Efle, thank you very much for joining us today.
Thank you for having me, Paul. Always great to be on the show.
And I'm Paul Harris. Stay tuned to Kitco for more from the PDAC.
Kitco Mining's special coverage of PDAC is brought to you by Gold Mining and Uranium Energy Corps.